Look how they're telling again what's coming. But see, you know why they're doing that? Because so many of us independent researchers are exposing the truth and they can't hide it. But here's the difference. You see, when they give you a little bit of truth, it's just my opinion, but you read this for yourself. But when they give you the truth, notice how they always try to sprinkle in a little bit of lies. They try to throw you off a little bit, just my humble opinion. But I'm gonna show you this, right? Then we're gonna get into something major. It's gonna be major later on. But this article here is titled AmFIF. Listen, anytime AmFIF gets involved, it's major. It's serious business. They don't step in until things are serious. We've been covering things from AmFIF for like almost three going on 4 years. Every single time they step in, it's for something that's going to be major. They don't waste their time. But anyway, this article is titled AmFIF Survey. Wait, let me scroll up. AmFIF survey respondents believe substantial level of tokenization is still 3 years away. Wait. Now, the part I believe is that substantial levels of tokenization are coming. They're going to elaborate a little bit. It's going to blow your mind. If it doesn't, I don't know what you think is bullish. That could be more bullish than this. Because what we're looking at right now, because of that, they're confirming what I've been saying for months and months, right? I told you. Now, I'm basing what I said on BlackRock getting involved with RWA, with Wisdom Tree getting heavy into RWA, with a Ripple talking about we're going to go heavy with tokenization of real world assets. That's not for nothing. That's for trillions of dollars that will be easy to move, that will be easy to access. And when it comes on chain, any of these bank coins, when that comes to the bank coins, that could lead to an explosion in price. Like if it does come, it's going to lead to an explosion in price, but not financial advice. I have to be careful how I say things, right? Just my humble opinion. But there's no way you get around this when you have all those companies involved. Now, after we've done all of that, we went through all that research. Now AmFIF creeps in and they say, hey, listen, substantial levels of tokenization are going to come in. And they release this article. Look at this. This is how they bury things sometimes. Also, is by releasing them at times. They know you're going to be at work. They know you're running your small business. They know we don't have time to be reading an entire article like this at 9 a.m. in the morning. Who's reading? Well, besides some of us researchers, they know most people won't see this. Why not release this in the evening? When people are home, they're coming home, they're relaxing. Why not in the afternoon? People are on their lunch break. They might want to, scroll through the articles a little bit. No, 9 a.m. At a time, they could have released this at any time, folks, at a time where tons and tons of news about the Fed rate cut. This was released yesterday, 9 a.m. about the Fed rate cut and gold skyrocketing and all this other stuff was going to bury something like this. They do this on purpose because they don't want people to know. But let's read this little tidbit here. It says here, AmFIF also found that 65% of its respondents believed that bonds were the most likely to be tokenized, but that's not the only thing. Everything will be tokenized. We know that. Countries have been describing blockchain and tokenization as the future. That's interesting because a lot of the verbiage coming out of mainstream media over the years will make you think that blockchain is bad. But the countries, see how they're telling on themselves? The countries, according to AmFIF, they're so bullish. Isn't that interesting? They've tried to turn the people against crypto. All these articles written. I was there. I saw them. I read them myself. Crypto is dead. Crypto is bad. Crypto is not coming back. It's over for crypto. Remember that? Where do you think that's coming from? Meanwhile, the countries and the big businesses super bullish on crypto and creeping ever closer to domination in crypto so that when that massive bull run finally pops off, they get the benefit. That's why you got to be careful out here, folks. But anyway, it continues on. According to a survey done by the official Monetary Financial Institutions Forum, just the name itself tells you how serious AmFIF is. It says most respondents believe that a substantial level of tokenization will arrive in 3+ years. Folks, we're talking trillions of dollars scaled into quadrillions. This is not a game. You can read this for yourself. These are facts. They want everything tokenized. There's no way around it. I don't know when. I don't know how long, but I'm going to tell you what. When they say something, they're saying, it's at least 3 years away. Now, there's a certain way they put this that makes me question it. Now, let me read it to you. This is the survey consisted of a range of market participants and, quote, 92% believe that the financial markets will experience a substantial degree of tokenization at some point. Do you understand what that means? Listen, make no mistake about it. Ripple is one of those companies at the forefront. Quant is one of those companies at the forefront. Chainlink will be there. You see the slander going on with Chainlink now. Oh, so all of a sudden, they don't even have a reason. I'm seeing articles just written, oh, they're not bullish. They're bearish on Chainlink now. Can you tell me why? You don't have a reason why? Because everything they've been doing has been super bullish. No, I remain super bullish on Chainlink. They will be there as well. Solana will be there. Stellar has its place. Algorand is there. In my humble opinion, of course, not financial advice, but if you're at the forefront and you take a piece of this, those prices can't stay low. They can't. There's no way. There's no way. I mean, you may disagree. A lot of people disagree with what I say. Perfectly fine. But I don't believe that. I believe that price cannot stay low. How high? You got to make up your own mind about that. It says 92% believe that the financial markets will experience a substantial degree of tokenization at some point. Although all of them said, really all of them, that you don't find that suspicious? All of them said that it is at least 3 years away, unquote. There's no way everybody says the same thing. No way. No way. I find that suspicious. I just don't believe that timeline. Not with as much development has gone on. Number one. Number two, everybody's waiting on the private sector. We're so close to ready to deploy in mass. So close. I just don't see that being 3 years away. That's number two. Number three, most of the businesses and commercial banks, and this is something we're going to jump into, most of the businesses and commercial banks don't want to work with the legacy system. I know you might probably think it's different. It's not. Do that research. I'm telling you, you're going to see it with your own eyes. Don't let anyone just tell you. Don't even let me just tell you. I'm just here to give you information, and then you go check it out for yourself. They don't want to work with the legacy system. We're about to jump in that in a second, but let's cover a little bit more here because they're telling the people an opportunity, the likes of which we've never seen before. It never existed before, and it will never exist again. That is coming. And they're also they're telling on themselves through their actions that they've been lying to the people, setting the people up so that as per usual, only the big money people benefit. And then the little people get the crumbs that drop to the floor. Not this time. No, not this time. Because there was a new 1% there. Just my humble opinion. It says countries around the world have been describing blockchain and tokenization as the future. Interesting, isn't it? That kind of goes in contrast to what a lot of these regulatory entities that represent countries have been saying. They've been going against crypto for the longest. All crypto's bad, all illicit financing. But the countries themselves, where does this come from? Because this wasn't made widely public, or else all the people of the world would be bullish on crypto. You see this game that they play? Am I looking at this wrong? Have I been in an alternate reality? Because I don't think so. Right, but they're bullish. Right. According to the think tank Amphif's survey, 42% of respondents agree blockchain will. I was saying this the other day. Now let them tell you. Did you make it this far in the video? They're going to tell you. Here, they're telling. Listen to this. If this doesn't get you bullish and fired up, I don't know what does. Not that I'm here to get you bullish. I'm not. I'm just saying, if you don't feel something from this, you're probably a little bit numb. According to think tank Amphif survey, 42% of respondents agree blockchain will become the dominant form of financial market infrastructure. It's over, folks. They just told everybody, although only a little bit of us going to hear it, just me, you, and a couple other people. That's it. We hold a piece of the dominant, how did they phrase it? The dominant form of the financial market infrastructure. This is not a game. But we're about to win. In my humble opinion, we're about to win. Everything. Didn't I tell you? I put it in my own way. But everything looks good. The trajectory is upward. If it were different, it would be undeniable. We're working with actual facts, data. How much more raw can it get? Amphif is telling people this now. Now, are people going to spread this around? Right? Tokenization is the digitization of real world assets. Once again, it's a blockchain will become the dominant form a financial market infrastructure. Wait a minute. Let's slide. What's H bar's technology called again? Let's slide hash graph in there. They should have said DLT. Hedera will have a significant piece. They will do their thing. They're not blockchain. They're hash graph, but we go hand in hand. All right, man. This article gets deep, but I have to move on to the other news. All right. So now look at this. Wait a minute. There's more. Oh yeah. There's a lot happening right now. Besides all the Fed rate cut, it looks like the experts were right when they said 50 basis points. And then you had the legacy system economists and researchers come out and they were saying 25 basis points. But I think I saw that they made a 50 basis point cut. I think that's what it was. But putting that to the side, because I don't need that to be a distraction right now. We have to move on to things that are important. It says here, emerging markets risk. Look at this. They're showing you they're afraid of alternative systems, but why are they afraid is important. It says emerging markets risk over reliance on money market funds. BIS warns. Now, what do we know about money market funds? I've been covering this a lot, especially in the members only section. I love a good money market fund for sure. The non-banking financial institutions and a lot of various providers of different forms of money market funds and money market accounts have been taking the business away from the banks. The deposit flight, a lot of that deposit flight has been going both into gold. I love gold, but it's also been going into money market funds to the point where they don't know what to do anymore. So it's to the point where now legacy system companies like, who was it recently? Come on, folks, help me out. Wisdom Tree. Wasn't it Wisdom Tree? The last few days, Wisdom Tree is doing something with money market funds, or they're trying to get involved. Or so it's something new that they're doing with money market funds. But the banks can't stop them. They can't compete with non-banking financial institutions is the more technical name for the shadow banks. I don't know how many people, understand that. So, and shadow bank is a way for them to put a negative on non-banking financial institutions, which the legacy system cannot compete with. Why is that important? It's important because in order to compete, they must congeal with the new financial system. Why are money market funds, especially before a heavy Fed rate cut? Let's just be clear about that. We'll see how that affects yield. We'll take that into account later. But what's so delicious about money market funds? Money market accounts. Oh, you mean they give you delicious yield? That savings accounts where your money goes to die just don't give you. Hence why banks can't compete with non-banking financial institutions. They can't compete with shadow banks. So how do they do that in the future? Oh, you mean like staking? Like how you get this high yield from staking and being able to offer that to their customers in the future? Yes, banks want that. You mean like delegation, where you can earn this high annual percentage yield for your customers and offer that to them, and they'll probably take a significant piece. But even if the banks take a significant piece, it still will be way more than what a dead savings account offers one. Right? They need it. They want it. They see it. This is why this is a setup by the BIS. And a lot of things I respect from the BIS. I don't really have a big problem with the BIS, honestly. They've told the most truth out of all of these big organizations, although I would never trust a big organization. They have them. I give them the most respect. But this is a setup where they're trying to shake people. Oh, they're emerging. They want that. They want those emerging markets. Why? Because those emerging markets have a lot of resources. There's a lot of value going to be coming out of there. They're developing very quickly, very quick. There's a lot of capital to be made there. Not only capital value, but bigger than that, there's a lot of power to be grabbed there. They want control of that, and they can't do that right now. So they're trying to find a way to get people out of those money market funds in those emerging markets so that they can creep in and have their offerings to be utilized. You get what I'm saying? It's all a setup here. And if you read that, you're going to see this. Why would the people in those countries give up money market funds for a dead savings account? Or banks that could collapse at any moment? They're part of systems that are going to be siloed. They don't offer them good annual percentage yield. I mean, why would they go for that? But this is what it says here. Just a little tidbit. This is emerging market local currency stocks and bonds have become increasingly sensitive to moves in the dollar over the past decade as foreign investors play an ever larger role, according to the Bank for International Settlements. That vulnerability has also been increased by the fact that much of the money comes in through mutual funds and exchange traded funds. My apologies, money market funds, mutual funds, and exchange traded funds, ETFs. The bank said in a report published, quote, these funds display a greater sensitivity to the dollar than other investors, unquote. I mean, I think they mean investments. That's a typo. It says analyst Gaston Gelos, Pietro Patelli, and Ilyok Shim wrote. My apologies. I'm trying to get those names correctly. It's just a thing I like to do. I like to pronounce people's names as well as possible. That's how I feel comfortable. Developing countries should broaden their investor base to avoid and, quote, over-reliance on mutual funds. Wait a minute. Let's go here. I want to make sure that we're educating ourselves and getting everything 100% correct. Let me open up one of these apps very quickly. Bear with me. And let's type in here, what is the difference? Oops. I made a typo. What is the difference between a mutual fund and money market fund? And what are the similarities? Let's see what it tells us here, folks. Let's learn a little bit, right? It says, while both mutual funds and money market funds are types of investment vehicles, they have several key differences in terms of their structure, purpose, and risk level. Mutual funds invest in a diversified portfolio of stocks, bonds, and other securities to generate long-term capital gains and income for investors. Two, generally carry a higher degree of risk compared to money market funds, with returns that can fluctuate based on market conditions, are not insured by the FDIC. Aren't some money market funds and cash sweep accounts are not FDIC dependent on the amount that you have in there as well, right? Am I wrong in that? Are not insured by the FDIC or any government agency. I think like with sweep accounts, you get more. There's like a partial coverage or you get full coverage. So let me just put that out there. Money market funds invest in short-term debt securities such as T-bills, commercial paper, and certificate deposits. Aim to somebody out there's like, stop stuttering, Mick. Get on with it, Mick. People, my word, impatient. It says number two, aim to preserve investors' capital and provide liquidity while generating modest returns, typically considered low-risk investments with returns that are generally more stable and predictable than those of mutual funds. Here's the similarities, very important part here. All right, if this will ever scroll down. Number one, both mutual funds and money market funds pool money from multiple investors to invest in a diversified portfolio of securities. Yes, that's what always comes to mind are the similarities when I'm thinking about them. Two, both are professionally managed by investment advisors who are responsible for selecting the portfolio's underlying investments and managing its overall performance, which right now, because of how things have gone over the last few years, I'm looking at the global picture, not the U.S. picture. Okay, two completely different things. But globally, because people have talking on social media so much, the bad investors, like the bad management, people who manage investments, the management advisors, what do they call these people? Investment advisors. The bad ones have been talked about so much that they're getting like very little clients and eliminated. And so people are now like sort of giving a lot of business to very good investment advisors. So a lot of people globally right now, from what I'm seeing, I mean, maybe you're looking at different data than I am. That is possible for sure. I'm just telling you what I've seen. So now a lot of people are pretty satisfied with what their investment advisors have been doing. So I don't see why they would switch if they're doing very well. Why would they change things? Three, both offer investors and benefits of diversification and professional management, making them popular options for those seeking a more hands-off approach to investing. Exactly. The similarities are so powerful. It doesn't matter which one it is. The banks don't want you into either one. Either one. They're trying to get you out of both. All right. So that's my point here. But wait a minute. This all, once again, it has huge implications for their desire for the new financial system to compete with mutual funds, to compete with money market funds. So now here's something else that's going on. Let me read this to you from Google. Commercial banks, right? The central banks have a big problem with commercial banks. I've been talking about this for years, that the commercial banks don't want CBDCs. They don't want to use CBDCs. That's why you see the problem happening in Hong Kong, where nobody's pushing their ECNY. Sure, they have to comply to a degree, but there's ways of resisting, and they have been resisting for sure. You're going to see this as CBDCs get deployed around the world more in mass, that there's going to be resistance. The commercial banks don't want them. Right? And why? It says here, commercial banks are concerned about central bank digital currencies for a number of reasons. Loss of deposits, same thing they said 3 or 4 years ago when we first got here. It says banks are concerned that households will prefer the risk-free CBDCs over bank deposits, which are cheap and a stable source of funding. And you know they don't want that. Reduce liquidity. CBDCs can reduce the amount of deposits banks have, which can make it harder for them to lend money. This is why they'll go with the private sector. The private sector is going to come to the commercial banks and say, listen, you can make more money with us. We're not here to stop your money. We're here to make money with you. We want both of us to make tons and tons of capital. That's why I think offerings from, companies such as Ripple, Quant, etc., could be so powerful, because they offer what the central banks cannot. What did they complain about in Hong Kong recently? The intermediaries, the commercial banks, they were complaining that there's no incentive there for them to even push that, because they don't make any capital. They don't make any money off of that. So what is the point, right? So now let's go here. I want to get to just a little bit of Bitcoin news. Let's see. I have to skip about 3 articles. I took so much time on the first 2. I was so excited about that. But look at this. BlackRock, multiple days in a row, continues their push of Bitcoin as a positive. And see, this is a great sign. They're doing it themselves, which is a beginning. That they haven't begun to put the money in the pockets of the mainstream media to push just yet. So they're doing it themselves, testing the waters. They know who listens to BlackRock. They know most regular people don't like them. So they're not here talking to regular people. Who are they talking to? They're not talking to regular people. Regular people hate them. They know that. They're not ignorant. So then that means what? They don't feel it's time for that mainstream push yet to get more of retail involved. Because if they did want that, with the knowledge that people dislike them, they would be quiet and they will let the media do the pushing for them. I think that's highly logical, right? But this is what it says here. It says, BlackRock releases a new report, quote, Bitcoin, a unique diversifier. BlackRock released a new report explaining why Bitcoin is a unique portfolio diversifier, detached from other assets. The world's largest asset manager continues embracing Bitcoin as adoption gains mainstream acceptance. Once again, I ask you, do you believe that these big timers? I mean, and when I say big timers, I mean everything that they do. One thing I can say, they go big or they go home. And I've never seen them go home before. They go big and they win. Do you think they got into Bitcoin to make a few pennies? No, absolutely not. Absolutely not. They got into Bitcoin to make an astronomical amount. And if they've gotten into Bitcoin, they know that everything else will go up with Bitcoin. They saw what happened in 2021, which means they've gotten in deep in everything else as well, probably by way of proxy, a bunch of little small buys that add up to a whole lot, but nobody would know that it's them, right? Bunch of anonymous wallets or something like that. But they're expecting crypto as a whole. This is what it tells me. They're expecting crypto as a whole to do something dramatically beautiful, right? That's why they're here. But wait a minute. Let's go on to another article, okay, before our time runs out here. I appreciate all you being here with me. We've been hot on the case. We've been working hard on the case. You've been unveiling things. I'm unveiling things. We've been doing a good job over here as researcher reporters, I believe. That's how I feel. Now, look at this. Bitcoin ETFs add $250 million in surge ahead of expected rate cut. Of course, the rate cut just happened already, but look at that surge. People are bullish. The companies are bullish on Bitcoin. It says Bitcoin exchange traded funds are seeing a fresh surge of interest. Figures shared by the blockchain data firm Arkham Intelligence show that American funds collectively added approximately $250 million worth of Bitcoin on Monday, the most added in a single day for more than a month. Following the jump, the price of Bitcoin itself touched over $61,000 per coin on Tuesday for the first time in September. Why the sudden spike? First, the basics ETFs are simply fun. Oh, then they go into that a little bit, but we already know. We know about all that. But it shows there's a positive energy bubbling below Bitcoin. It hasn't begun to erupt yet. It's bubbling. It hasn't erupted yet. When it erupts, it should be, theoretically, should be something beautiful. Just my humble opinion, not financial advice. All right. But in my mind, what I'm seeing here, I don't know when. I think in the next year, but I don't know when. I think that Bitcoin is going to explode dramatically. And I am sticking to my 100,000. Look, my low, 80 to 85,000. My higher range, 100,000, 150,000. I would not be surprised if it goes higher. I wouldn't be surprised at all, especially not with the mentality that a lot of these big money people have, where they continue to compare it to gold. They could, and it's like I don't believe Bitcoin is in the same class as sweet gold. I don't. But it tells me that maybe they're willing to push it. When they begin to pump it, and they will be telling people everywhere to buy Bitcoin en masse. They'll all want a piece of it. One thing that they all share, the people at the top, is greed. They're going to want a piece of that money, and that's going to pump that price up. The pump hasn't begun yet. So, I'm keeping that in mind also. Okay. So now that you have that information, what are you going to do with it? I know what I'm going to do with it. So until next time, everybody, let's get to the money.